SwayamPrabha. Digital India. Educated India.
Welcome to this session of Economic Environment and Business Strategy. So in the previous lecture, we explored the structure of financial markets, how markets function to connect savers with the borrowers. So in this section, we move deeper into the mechanics of that connection by focusing on two core components of the financial system. One is type of financial instruments, and the second one is types of financial intermediaries. So coming to the first part, types of financial instruments, we will begin by understanding the building blocks of financial transactions, that is financial instruments. So these are contracts or obligation that facilitate the transfer of money, risk, or ownership. We will examine instruments that money market and capital markets, including bonds, equity, that is stocks, treasury bills, commercial papers, and derivatives, and more. And each instruments play a different role in funding, investing, or hedging. So next, we will explore the institutions that make financial markets work. Intermediaries, they are called financial intermediaries. So these include banks, insurance companies, mutual funds, pension funds, investment firms, and government-sponsored enterprises. So we will examine how they mobilize savings, allocate credit, manage risk, and maintain stability in the financial system. So by the end of this session, you will have a clearer understanding of how these instruments and intermediaries together facilitate efficient financial flows and shape the broader economic and business environments. So let's get started. First, let us take a look at the key instruments traded in money market. So which is the segment of the financial market where short-term borrowings and lending occurs. So typically for maturities less than 1 year. So first I'm showing you a financial market instrument just to give you an idea. So I have given a definition here, formal definition. A financial instrument is the written legal obligation of one party to transfer something of value, usually money, to another party at some future date under specified conditions. So you can see here in the picture it has written bonds, equity, stocks, etc. So it's already mentioned here. So let us go it one by one. The first one is called financial, that the money market instruments. So because in the previous session I made the market into two market. One is called money market and the other one is capital markets. So in the money market, it deals with instruments that are less than 1 year. So let's first go through the money market instruments. So beginning with the treasury bills, government securities with maturities of 1, 3, or 6 months. So these are in general, they are sold at a discount and redeemed at face value, which means the difference represents the interest earned. So the treasury bills are considered risk-free as they are backed by the government and they are mainly held by commercial banks. So then moving to the second money market instrument is called certificates of deposits. Shortly we call it as CDs. These are mainly issued by banks. CDs are short-term time deposits with fixed issued by large corporations to meet short-term financing needs like working capital. Since it's not backed by collateral, only top-rated firms with strong credit profiles can issue them at a reasonable rates. So when I say there is no collateral, these are unsecured loans. That means when they issue this commercial paper, they don't need to give any collateral or any security as such. So then moving to the fourth money market instrument, this is called consumer loans. These are again short-term. These are short-term loans extended to individuals by banks or financial institutions. So due to individual credit risk, these loans typically carry higher interest rate due to high individual credit risk compared to other money market instruments. Then moving to the next one, that is called repurchase agreements. In shortly, we call it as repos. Repos are very short-term loans. So often overnight. Here, one party sells a security, usually a treasury bill, with an agreement to repurchase it a later date at a higher price. So these function as secured loans and are commonly used between banks, financial institutions, and corporations. Then moving to the last one here, this is called federal funds. Federal funds, or short, we call it as Fed fund. So these are mainly the loans between commercial banks, mainly to meet their reserve requirement at the central bank. So these are overnight loans between commercial banks. So typically used to meet short-term reserve requirements. So the interest rate on these loans is called Fed fund rate. Fed fund rate, especially in the US. When we talk about the Fed fund rate, it's mainly used in the US context, especially when a large number of banks buy from each other at a Fed fund rate. It's an overnight loan, mainly to meet the credit reserve requirement with the central bank. So it's a key indicator of market liquidity and often guides monetary policy in the US. Let's now move to the capital market. Capital market, as I already mentioned, capital market means the market dealing with the long-term lending. That means more than 1 year. So more than 1 year. So these are used for long-term financing. So I have listed out each and every instruments that are the commonly widely used instruments in the capital markets. So let us start with one by one. The stocks. Number one, stocks, which I already mentioned. So stocks means it represents equity ownership in a company. So when you purchase a stock, you essentially become a part owner of that company. So investors can earn returns through dividend and capital gains. So stocks carry higher risk but also higher potential returns compared to debt instruments. So simply, as I already mentioned here, by investing in the stocks, you may get potentially higher return, but at the same time, the risk is very high there. And similarly, the return that you are getting, one is in the form of dividend that the company announces periodically. If the company is earning profit, and share will be, you will get a dividend of this profit. And at the same time, if the share price is increasing and the share price is high after you bought it, then in case if you sell, you'll get a capital gain as well. Then moving to the second capital market instrument, that is called mortgages. So mortgages are long-term loans taken for real estate purchases. So these are typically repaid over 15 or 30 years. So the distinguishing feature is that the property or land itself serves as collateral, so reducing the lender's risk. So for example, if you are buying a loan for your house, that means that's a mortgage loan. Or otherwise, if you are buying a similarly, not otherwise, if you are buying a vehicle loan, that is also a mortgage loan. That means it's a mortgage because the vehicle, your automobile, that itself become a collateral. So that means the real estate, even the house, if you are taking a mortgage loan for proper your house or for a vehicle, then that itself will become the collateral. So then moving to the another capital market instrument, that is called corporate bonds. So these are debt instruments issued by large corporations. So is as compared to commercial paper also issued by corporation, but they are short term. But when they issue more than 1 year, that is called corporate bonds. So these are debt instruments issued by corporations to raise capital for expansion or operation. In the case of commercial paper, we have seen they raise it mainly to meet their steady cash flow for their to meet their short-term financial requirements. But in the case of corporate bonds, they are long-term in nature and are popular among institutional investors like insurance companies and pension funds. So individual investors also invest in these for stable returns. Then moving to the next one, this is the fourth instrument. That one is called government securities. So these are bonds issued by central or national government to finance budget deficits and other expenditures. So they are considered low risk and are widely held by banks, households, and foreign investors. So these securities form the backbone of sovereign debt markets. Then moving to the another one, that is municipal bonds, or that is mainly issued by state or local governments. So municipal bonds are used to finance public infrastructure projects like schools, roads, and hospitals. A key feature is that they are often tax exempt, which makes them attractive to certain investors. Then the last component, sixth component of credit market instrument, sixth form of market instrument is called consumer and commercial bank loans. So consumer and commercial bank loan, these are loans given by banks to individuals for consumption or to businesses for investment purposes. So compared to money market loans, these are long term. They form a major component of bank-based capital financing. So in summary, capital market instruments enable the transfer of funds from savers to users over the long term, supporting productive investment and economic growth. So what we have done here is that we made a distinction between money market instruments and capital market instruments. So shortly, in the money market instrument, we said that those instruments which maturity period is less than 1 year belong to the money market, and those instruments greater than 1 year belong to the capital markets. So normally in the money market, banks are the most dominant player in the money market. They make long-term loans and long-term investment. However, most of the transaction, especially raising capital, raising funds, mainly through deposits, they do it mainly through less than 1 year. That means through money market. So let's also make a distinction between, because I already mentioned this term repeatedly here, the treasury bills, treasury notes, and treasury bonds. So I thought of it's better to make a distinction here. Treasury bills issued for terms less than a year, and treasury notes issued for terms of 2, 3, 5, or 10 years, and treasury bonds issued for terms of 30 years. So I made a summary table here the instruments, its maturity term is given, the market type is given, and the key characteristics are also listed here. So in the case of treasury bonds, they are the longest maturity. It has fixed interest payment as well. So let us now move to another component of financial market. So what we have done so far is that we have gone through the previous session. We have discussed structure of finance market. Then just now we just completed the discussion on types of financial instruments by distinguishing between money market instrument and capital market instruments. And now we are moving to discuss the financial intermediaries, the types of financial intermediaries. So the types of financial intermediaries, one type of financial intermediary is depository institutions. Depository institution means these are the most familiar financial intermediaries, including commercial banks, savings banks, and credit unions. So what they do that they accept deposits from individuals and businesses, and they provide loans to borrowers. So they help facilitate payments and credit creations across the economy. So their role is mainly foundational. They mobilize savings and provide liquidity for economic activity. Then another type of financial intermediary is insurance companies. So insurance firms operate by collecting premiums and investing them in financial assets, so such as securities or real estate. So in return, they promise to compensate policy holders when certain specified events occur, such as death, loss, or damage. So there are two major types of insurance companies. That means broadly, insurance companies can be categorized into two. One is called life insurance companies. So life insurance means it protects against financial risk of untimely death. Then about the general insurance, it covers risks such as property damage, theft, accidents, or personal injury. So the life insurance is also called as non-general insurance, or otherwise general insurance is also called as non-life insurance, like that. So it is interchangeably used in that way. So these insurance companies, they manage risk for individuals and businesses while channeling premium into productive investments. So then we have moving to another type of financial intermediaries called pension funds. So pension funds collect contributions from employees and employers and invest them in long-term assets like stocks, bonds, and real estate. Over time, these funds grow and are used to provide retirement income to workers through periodic payments, that is the pension payment. So they are essential for retirement security and also act as major institutional investors in financial markets. Moving further, another kind of the financial intermediary is securities firms. So these firms are more central to capital market operations. So they facilitate the issuance and trading of securities like stocks and bonds. They offer mainly advisory services to corporate clients, particularly for mergers, acquisition, and capital raising. It includes mutual funds, which pool funds from retail and institutional investors and invest in diversified portfolios. It also includes hedge funds and private equity, which cater to high net worth individuals and specialized investors. So examples of securities firms include brokers, investment banks, underwriters, mutual funds, private equity firms, and venture capital firms. So let's now continue with the additional categories of financial intermediaries. Just for instance here, finance companies, mainly non-banking financial intermediaries. So these institutions raise funds from financial markets, not through deposits, and use those funds. They raise the fund mainly from deposits and use those funds to provide loans to individuals and businesses. So examples include loans for mortgages and automobiles and equipment. So while their assets may resemble those of banks, their liabilities are often market traded debt instruments rather than customer deposits. Then another type of financial intermediary is mainly government sponsored enterprises. So government sponsored enterprises, these are publicly supported financial institutions. They serve as a key developmental and social policy goals. So the government sponsored enterprises provide direct credit and lending to priority sectors like agriculture and housing. So examples include especially institutions that provide loans to farmers or help home buyers access affordable housing finances. So I have listed out some examples from India. For example, NABARD, the National Bank for Agriculture and Rural Development, it provides credit and financial support for agriculture and rural infrastructure. Similarly, SIDBI, the Small Industries Development Bank of India, and HUDCO, NHB, and these institutions help bridge financial gaps in underserved sectors and promise inclusive economic development. So together, these intermediaries enhance access to credit, promote investment, and ensure smoother functioning of both capital and money markets. So totally, to sum up is today's discussion, we covered two key components of the financial system. One is financial instruments, where we discuss money market and capital market, and subsequently we discuss financial intermediaries, where we discuss institutions that connect savers with borrowers. So it includes banks, financial firms, insurance firms, pension funds, security firms, finance companies, and government sponsored enterprises. So these components help mobilize saving, allocate capital efficiently, and managing financial risk. So thank you for the careful attention to this lecture, and see you in the next lecture. Thank you.